break in silver did no damage to long-term momentum. Annual momentum, it's just a sharp drop. We regard this as a three-wave corrective process with a low at 64, a low at 61, and now a low in the 56 level last week. Don't be shocked if you get back above that prior set of lows. You can take your gold and silver charts and throw them away, and your mining charts. All that matters is this spread. Gold get back up to 4,900 again, 5,000. Silver get back over 90. That's when people are going to start waking up and say, well, golly, I guess that was just a sharp correction followed by mostly sideways action. And they're going to put some money into miners because most people don't buy silver futures or gold futures or call options on silver bullion. They'll buy miners. I think we're headed to the bottom again. That's a doubling in the miners' relative value to gold. You can bet that means if gold's going to double from here, which we think it easily could, if it just merely matches the prior bull markets, it'll be eightfold, meaning $8,500 gold. We've found that when you generate a major bear trend or a major bull trend, you break out over momentum structure first. And that momentum structure is usually very clear.
What are we seeing here on the silver chart?
Well, you'll see that if you can widen that screen a bit and look at each of those monthly bars. No, I meant the other way. Yeah, expand it. So we can look at those bars. No, wide. So I can see those 5 bars that we just had more clearly up close.
5 bars.
Yeah,
this way.
Yeah, those bars that since the January peak. You look at the January high and look at the February low, the next bar. Mm-hmm. Okay, that low was $64 going down. There you go. Look what's happened since. Up, down, up, down, up, down. So we've had constant selling, and now finally, a week ago, we punched through that low. Okay, so now that's where anybody who was hanging on looking at a stupid price chart and saying, if you take out that low, I'm gone. Okay, well, they're now out. Okay, so you can assume that the last late coming non-investment grade investor is out of silver now because he probably got in not at $50 or 35 or 25, which is our last buy signals, but got in at 100 or so. And so he had something handed to him. Okay. And now he's been stopped out. And so far it's been a week and a half and we're still lingering just below that low. Don't be shocked if you get back above that prior set of lows, the February low and then the March low, which was 64 and 61, respectively.
Markets often look weakest precisely when emotional sellers finally surrender. Michael Oliver notes that silver's break below prior lows may represent exhausted liquidation rather than the start of another structural collapse. Institutions frequently welcome forced selling because it creates liquidity, while headlines amplify fear among retail investors. If this proves to be a false breakdown, patient holders could benefit while late sellers lock in losses. Next, Michael Oliver reveals why momentum is refusing to validate this breakdown despite the frightening price action.
And that's it. We see 3 waves of selling here, and you can see it more clearly on momentum. But when you get 3 waves of upside or downside that are clear, very objective. You can see it here. 1, 2, 3. Okay.
So you're saying here.
Yeah, and the third one was very protracted. It took them a lot of arm wrestling to get it down there, a lot of months. Whereas the first 2 were like in 1 to 2 months, and then 3 or 4, and then it took a long time. So there was support on the way down. If you abort this breakage and get back above it, if you're a smart price guy, you'll say, shouldn't have done that. That was a bear trap. So you get back over 64 or 61, which is the March low, that second low there. Now, also, when we run momentum of this, we find that this low that took out the March low is not even anywhere close to generating the low momentum readings we had in March, meaning momentum is not confirming this new low on our long-term momentum charts or our intermediate charts even. And also, this break in silver did no damage to long-term momentum. Annual momentum, it's just a sharp drop. There was no structure, no uptrend line defined by 3 points, no floor defined by a couple points. It wasn't even close to a structure. In other words, it's just a sharp pullback in thin air.
The market just printed a lower price, yet one critical indicator refused to follow it lower. According to Michael Oliver, that divergence matters because weakening momentum often appears before major reversals, not after them. History shows that failed breakdowns tend to trap traders who react only to price while ignoring underlying market strength. Investors focused solely on headlines often miss these subtle timing signals completely. Next, Michael Oliver exposes why this momentum divergence could invalidate the entire bearish narrative.
And we found that when you generate a major bear trend or a major bull trend, you break out over momentum structure first. And that momentum structure is usually very clear, much like that spread chart. You talk about clear, that's clear, okay?
Yeah.
No such breakage occurred in silver or gold in this break. It was entirely an intermediate trend momentum factor were broken. Things like weekly momentum, 3-month average momentum, 50-day momentum, not annual momentum, which is like measuring price versus a 3-year average or 36-month. So we regard this as a 3-wave corrective process with a low at 64, a low at 61, and now a low in the 56 level last week. We think we're going to turn back up soon. Most of our shorter term intermediate stuff suggests this is about over. And when you flip back up through some levels that we specify in our reports, game is on again. You won't get a 4th wave. It's over. You're going up. And I think that'll shock people.
We've got a question here from Christian. He's asking about comparing today's gold market with back in the 70s. He says when he looks at indicators and compares today with 1974 to 75, it looks scary similar. What makes this current situation more of a 1979 market in gold and silver? I'm scared we could be going down, way down before we go up. And I'll share my screen here so we can get a visual of what the 74, 75 was and the 79.
A sharp correction feels catastrophic until you measure it against a larger trend instead of daily emotion. What Michael Oliver is highlighting is that long-term momentum remains intact even while shorter-term indicators weaken, a distinction many investors overlook. Wall Street often encourages reacting to volatility because frequent repositioning benefits intermediaries more than disciplined holders. Preserving wealth sometimes means resisting emotionally convincing narratives during temporary corrections. Next, Michael Oliver unravels why comparisons to the 1970s may be more bullish than most investors realize.
And basically, let me go to the spot market here. And 74 to 75 was kind of like this drawdown right here.
Yeah.
Basically, there kind of didn't, if you bought at the peak here, you weren't.
50% pullback. It took from January 75, as soon as it began trading in the U.S., to August of 76. And then it went up 8-fold.
Yeah, and then after that, we just had this parabolic move.
And then it had another drop, and it went sideways for a decade or so. And then in 2001 through 2011, it had another 8-fold move. Punch up a gold chart if you can, monthly, especially.
Monthly?
Going back to, let's say, 1975 to the present, but put it on a logarithmic scale.
Put it on log scale. Okay, boom. Okay.
Now, you see 2 big surges there. The one from 70 through 75, that's an 8-fold move, especially from the 70s.
Right here. Okay, yeah.
Yeah, the 76 low was at 100. That 50% drop right there. That was a 50%er there, that drop you see right there. Yeah. From that 100 to 850, 8-fold gain in price. Okay. Then you go back to the next low in 2000, 2001. It's about 260. Went up to 1920, 8-fold move. Different span of time, more years involved, but still an 8-fold move. Okay, we're right now at a 4-fold move, measuring from bear low. Yeah, from our recent bear low. We're only 4-fold gain. So we're half as much gain in price on a percent basis as the 2 prior bull markets.
History rarely repeats perfectly, but markets often rhyme with surprising precision. Michael Oliver's argument suggests investors may be focusing on painful corrections, while ignoring that previous secular bull markets delivered far larger advances afterward. Financial media frequently magnifies drawdowns, yet rarely places them within decades-long historical context where trends become much clearer. Long-term positioning depends more on cycle recognition than short-term fear. Next, Michael Oliver reveals the overlooked comparison that challenges today's widespread belief this bull market is already exhausted.
And yet we have factors out there that are far more enormous. fundamentally, technically, and so forth. And when we run annual momentum, something you can't do here, of gold. Oh, you've got that's an XAU there. That's an
Oh,
XAU.
this is spot gold, basically.
Oh, a spot. I see. Okay,
Yeah.
I'm confused by the
Spot gold allows me to go back to the 1800s, and futures gold only
those
can
don't
take
mean
me to.
anything because it was fixed and controlled back then.
Yeah.
Anyway, but the point is we've only had an eightfold move. Excuse me, a fourfold move versus the two prior bulls since gold was legalized, 76 to 80, 2001, 2011. There were eightfold gains. Oh, with sharp drops in the middle, but we're only fourfold. Now, and when we look at the horizon of the technicals, not only outside of gold, but the financials especially, the debt markets of governments, not mortgages, Japanese government bonds in total doubt, U.S. government bonds on the cusp, and frankly, UK and so forth. We have a crisis that, like Jamie Dimon has told us, 4 or 5 weeks ago, he says, we're facing a government bond crisis. We're going to have to deal with it. He didn't mean 10 years from now. And technically, we fully agree with him. He's right on his timing of his comment. That's a problem the Fed can't ignore. It's not a mandate for them, but they must defend the house from burning down, okay? So, and they'll do whatever it takes, print, et cetera. Gold knows this. Anyway, that's what we're facing.
Government bond markets rarely dominate headlines until stress becomes impossible to conceal. This is where Michael Oliver's thesis shifts from chart analysis towards systemic financial risk that could reshape capital flows. Bond market instability pressures policymakers long before official messaging changes, creating a widening gap between public reassurance and institutional concern. Investors protecting purchasing power should watch sovereign debt as closely as precious metals prices. Next, Michael Oliver exposes why central banks may have fewer policy options than markets currently assume.
And also when we examine the peaks that occurred, like in 1980, especially that 2011 peak, we went major bearish. Why did MSA go major bearish? Because annual momentum of gold at those times broke massive structures that if you looked at the momentum chart, you'd say, golly, I got to get out of this thing. Whereas on price, you weren't quite sure for a year or so after the high, whether it was topping or not. Momentum said, you're done. It said at 2-3 months after the September 2011 peak at 1920, in December, we warned of a top. And in January 2012, we said, that's it, you've topped. We're going to have a major bear market. It took it a while, another year or so before it finally collapsed, but it did. But annual momentum right now, we have a sharp pullback on momentum, but it is no way breaking any structure. So a pullback is one thing, sharp one even. But unless it's breaking some trend structure, we dismiss it as merely a sharp correction within the context of an ongoing annual momentum bull trend. And I think that's where gold is right now. The S&P, for example, is not in that condition. Its pullbacks have massive structure it can break on annual momentum. So when I look at the two asset categories, you say, well, gold's dropped more than the S&P. Well, gold's not breaking anything of technical significance on annual momentum.
Price grabs attention, but structural momentum often decides where wealth ultimately flows. Michael Oliver notes that today's pullback lacks the technical damage that accompanied previous major tops, making superficial comparisons potentially misleading. Markets often confuse volatility with deterioration, encouraging investors to abandon strong trends prematurely. Distinguishing correction from collapse can dramatically influence long-term portfolio outcomes. Next, Michael Oliver reveals why equities may actually be carrying greater hidden technical risk than gold itself.
The S&P is dancing on glass. Levels, not just S&P, NASDAQ, banking sector, you name it, of levels that if it triggers, and I think we'll trigger them early next quarter, begin the game, the major downside. Now, and when you get a major downside in the stock market, historically, gold is the beneficiary. Yes, there might be a month here and there within the bull trend of gold where gold says, I'll have a bad month along with the stock market. But in general, it is opposite. It rises during stock bear markets. And 29 to 32, it didn't because it was illegal. But home stake mining went up 1,000%. Okay. Well, the stock market went down 80%. So I think we're in that same context. And what is going to be the headline booster for gold is going to be when these headlines hit that nobody's expecting, namely financial problems, government debt, private debt. Ooh, suddenly a bad headline about a big bank. Oh, no, we can't have that, etc. And it'll be late in the move. And that's when the public will suddenly say, gee, I got to be part of this. And that's when you get the wet bar of soap chasing. Got to have that. Okay. So what we're saying is when you break out of this, gold's had a quadrupling in price during that time, and the miners have had more since 2015. But the game just begins. The game begins. Meaning something explosive is going to happen on the other side of that spread.
Markets usually reward preparation long before they reward prediction. According to Michael Oliver, major equity weakness has historically redirected capital toward precious metals after confidence in traditional assets begins to crack. The critical mistake is waiting for alarming headlines because institutional money typically rotates well before retail investors recognize the shift. Protecting wealth means respecting market sequencing rather than reacting emotionally to breaking news. Next, Michael Oliver exposes why the first banking shock could become the catalyst gold investors have been anticipating.
So you can actually, and we're not going to do this, but you can take your gold and silver charts and throw them away, and your mining charts. All that matters is this spread. When you break out, you'll have an instant electrification of this market sector.
Okay, and typically, correct me if I'm wrong, but typically when we break out of structures like this, since we've got, I guess you could call this a triple top here that took a decade to form. This is the monthly chart, right? Every little bar here is
a triple top breakout. Yeah.
Yeah, I mean, I kind of looks like a little bit of a bull flag right there, right above.
Yeah, right. You notice that it's been, 5 months? See, they peaked in Feb, March, April. Yeah, in Feb is when it peaked, not January is when that spread peaked. Look at the downside. The next month was a sharp down candle. Mm-hmm. But since then, it's been sideways.
Yeah.
The miners have been holding their ground. Whereas look at those other highs over there. When they broke down, they went down.
They went down, yeah.
Yeah, and they didn't nestle right below the top of the range.
Yeah,
We've been going up and touching the top of the range almost every single month.
Yeah. It looks like a bull flag to me. And typically when these break out, you might have a little retrace, but it's usually a pretty quick.
This is so massive that the air above it is so thin, and the what I'm suspecting here as a helpful causal factor is that the investor.
The strongest opportunities often emerge when prices refuse to fall despite relentless negative sentiment. What Michael Oliver is highlighting is that miners have absorbed selling pressure without breaking key relative levels, a subtle sign institutions may still be accumulating. Retail investors usually focus on daily fluctuations, while professionals monitor relative strength for early confirmation of trend changes. Missing that distinction can mean missing the most rewarding phase of a cycle. Next, Michael Oliver reveals the overlooked breakout signal that could rapidly reprice the entire mining sector.
Especially U.S. investor who is not in the gold market, the silver market, or the miners, to any percentage of significance, whatever. They're still ignoring it. And right now they think, oh, we're smart. We ignored it, okay? Yeah, well, wait, you take this out, the game's on. That likely one of the causal factors of that will be the financial sector that we mentioned. Suddenly you start to get headlines from places people don't expect. But two, the stock market begins to show evidence that, it's breaking. I don't mean 50% drop, but I mean, you even get 10, 20% off the high. The average guy with a retirement account is going to say, gosh, the only thing I had to smile about for the last year has been my stock portfolio. Unless, of course, he was in gold or silver, and they're still up from a year ago. But when he loses faith in that, where's he going to put it? In government bonds? Even the chief investment officer of Morgan Stanley, I think 6 months ago, said that the 60-40 rule is gone.
Yeah.
60% stocks, 40. It's now 60, 20, 20, 20% gold. At least he admitted the right direction there. Okay. And others have now said, agreed with him, by the way. But when the average guy out there feels sufficient pain to consider moving some of his money out of stocks, used to be he'd put it in T-bonds because that was an alternative.
Conventional portfolio rules often fail precisely when investors depend on them most. Michael Oliver's argument suggests capital could leave both stocks and government bonds if confidence erodes across traditional assets simultaneously. Institutions quietly adjust allocations before public consensus changes, while retail investors often wait for reassurance that arrives too late. Wealth preservation depends on recognizing shifting capital flows before they become obvious. Next, Michael Oliver unravels why the classic 60-40 strategy may no longer provide the protection investors expect.
It's not an alternative anymore, like Jamie Dimon said. Okay?
Yeah.
And the Fed knows this. And so all of a sudden, you as an investor, where are you going to put it?
Right here.
Yeah.
Gold and gold miners.
Especially when you see the next upside burst in that spread, but also when you see, like, let's say gold get back up to 4,900 again, 5,000, silver get back over 90. That's when people are going to start waking up and say, well, golly, I guess that was just a sharp correction followed by mostly sideways action. And they're going to put some money into miners because most people don't buy silver futures or gold futures or call options on silver bullion. They'll buy miners. Some of these miners offer pretty good income as well. So I'm going to guess that when this spread does break out, and I think it will, we're monitoring it week by week, month by month, you can pound the table. And this will be probably the best place to be on the planet, especially during the initial burst that comes out of that hole. Okay.
Okay. Yeah, and what you're getting at here, when you have a base like this that lasts over a decade, usually when you break out of it, it's not a gradual thing. It's usually kind of violent and quick, kind of like we can see here. Like, see how we have this base here that lasts 10 years.
Look at
when
what 3 months did.
It went, right?
3 months, yeah. 3 months, yeah.
Okay.
The safest asset can quickly become the most crowded trade once confidence suddenly shifts. This is where Michael Oliver's thesis shifts from technical patterns to investor psychology as money searches for credible alternatives. Markets rarely transition gradually after decade-long bases because suppressed demand can overwhelm available supply in surprisingly short order. Those waiting for universal confirmation often pay substantially higher prices. Next, Michael Oliver reveals why explosive breakouts usually leave hesitant investors chasing instead of leading.
Yeah,
okay.
No, that's what I'm expecting because there's no, and look where the rally occurred after that break, right back to the underside of the old 17 and a half. See that rally that occurred right there the next few months?
Right back up.
Up the bottom. I think we're headed to the bottom again.
Yeah.
But that's a doubling in the miner's relative value to gold.
Yeah.
You can bet that means if gold's going to double from here, which we think it easily could, if it just merely matches the prior bull markets, it'll be eightfold, meaning $8,500 gold. We started from 1,050. Well, if gold doubles and miners double versus gold, you do the math.
That's a nice return.
Yeah, okay.
The biggest investing mistake is assuming tomorrow's winners must resemble yesterday's leaders. Michael Oliver notes that if miners outperform alongside rising gold prices, compounded returns could exceed what many conventional portfolios can realistically achieve. Wall Street typically embraces precious metals only after sustained gains remove much of the opportunity. Investors who understand relative performance often position well before the crowd notices.